Hey everyone. The other day I was giving a presentation at an event, and the speaker that preceded me was an economist with a top financial institution. His presentation focused on the economy, inflation, and recession risk. Interestingly, his firm pegged the risk of a recession in 2023 at just 35%. Most other notable economists have placed the risk of a recession in the 65% range. Their thesis was based on leading inflation indicators that have begun to ease and the prospect that the Federal Reserve could still pull off a soft landing. But is inflation really coming down? Looking at the CPI and core CPI, it does appear that we might be on the backside of the trend. But there are certainly no guarantees. Wall Street certainly rejoiced on November 10th when the October Consumer Price Index reading declined and headline inflation retreated from 8.2% to 7.8%. Digging under the surface, there are some promising trends. The price of lumber, which peaked at roughly 4 times higher than it was before the pandemic, has come back down. The current price of lumber is actually a few percent below where it was in February of 2020 before the pandemic hit. Likewise, steel is almost back to pre-pandemic pricing after it also quadrupled in price during the health crisis. Another metric I've been following is the cost of shipping a container from China to LA. Before the pandemic, the shipping cost was about $1,400 per container. In September last year, the cost peaked at $19,200, and since then, it has come back down to $2,700. It's still double the pre-pandemic level, but down 86% from the peak. That's good news. We're also seeing a downturn in the Producer Price Index, which measures wholesale prices. These costs are now only increasing by 8%, down from a peak of 11.7% in March this year. This will be an important indicator to watch because if manufacturers are paying 8% more for materials, then the products they produce will likely cost more. So all these indicators offer promise, but will it be enough to get the Federal Reserve to back off on their interest rate increases? At the Fed's November 2nd press conference, Chairman Powell suggested the Fed would likely make smaller rate increases going forward, so they already plan to ease up on the pressure. That said, the Fed is still expected to raise the overnight rate by 50 basis points in December, followed by a 25 to 50 basis point increase in February of 2023. After that, the Fed may coast for a while to see how things go. The consensus is that the overnight rate will peak in the 5% range, give or take 25 basis points at some point next year. For real estate investors, that suggests a bit of a bumpy ride in 2023. Even if a recession is averted and inflation begins to abate, there will still be ripples that affect space demand for all types of commercial real estate. The good news here is that the rate movements should become less volatile and a bit more predictable as the Fed eases back from its aggressive stance. That means buyer underwriting and assumptions could become more stable, reducing some of the interest rate driven retrades that have been taking place. That would in turn narrow the buyer-seller expectation gap and alleviate some of the uncertainty in the commercial real estate transaction market. That would be an important step towards stabilizing the commercial real estate investment market overall and allow investors to focus their attention on their broader strategies and help them keep their eyes on the horizon.